All right, good morning, ladies and gentlemen. Today is Wednesday, January 15th, 2020, and the market is hitting a new record high as we speak. Today's the day that the U.S. and China are signing phase one of the trade deal that's been going on for, well, I guess you could say the negotiations have been going on for a year and a half, right? Trade war started in July of 2018. Pretty amazing. And so here we are. We're looking at the signing, or we're going to see the signing of phase one, which is kind of interesting that it's been split up. And so it is what it is. And as you know, the market has just been on a tear here, right? Absolutely amazing. No signs of letting up or cracking yet or whatever. It's just kind of amazing. Every day I come into my office, flip on the computers, flip on CNBC, and it seems like almost every day the market's up a little bit in pre-market. So yeah, they've had a few down days, but the conventional wisdom, here's the thing: is the market's clearly overbought. It's been it's been on this path since back here. I would say that the current rally really started back here. I'll drop a trend line there. So and I've gone over this. I kind of go over, review where we are each week, but there's a couple of days there. Late this day on Thursday is when Trump actually announced the whole phase one trade deal thing. And then we got the gap up the following day. And then somewhere shortly thereafter, here's where the Fed lowered rates for the third time in a row. These three circles I have here, when the Fed cut rates 25 basis points three times in a row. And somewhere in between this trade deal and then actually cutting rates or whatever, is when is when they talked about the QE4. QE4, is that right? Basically, it's the Fed adding to their balance sheet. They're not calling it QE. And then, we had all that repo stuff going on back in here, whatever. But so anyway, the Fed is extremely accommodative, right? But what I was getting at is so this current rally started back here, right? Kind of a confluence of events. And but what's amazing about it is sort of the persistence of the trend right here, right? If I put a if I were to like add a linear regression line, which I could do to this chart, the persistence of this uptrend is extraordinary. One little dip here, I don't even remember quite honestly, I don't remember what that was about. There was the one little sell off and then that crazy day and then right back. And so the thing about the persistence and the angle of this particular trend is seems kind of unsustainable, right? But hey, you never know. You never know how long, these things they always tend to they always tend to go longer. And since the market's at all-time highs, right? Since the market is at all-time highs, the shorts. See, here's the thing. There's like this level right here. It's kind of interesting how all this there's like sort of a confluence of things here. But what's interesting about this is that, of course, this was Fed Day, right? That I have circled right over here on I guess it was October 30th, yeah, day before Halloween. So that was the most recent rate cut, and so the market was right up at the all-time high, and I mean it just hasn't looked back since then, right? And so more interesting is the fact that move my chart back around. So now, this is a huge level of support and it's way down there. I mean, if you think about it, we're almost at 3,300, and here this is, this breakout to new highs is at, 30, call it 3030. And so anyway, what I was about to say is that, a lot of this has to be due to short covering on everybody's working with different time frames, right? Institutions and who actually drive the market. It's not mom and pop investor. Although to a certain degree, mom and pop investor put money in their 401ks. Company matches it, and so there's always like an inflow into the market, right? But anyway, yeah, this is pretty amazing because when the market started breaking out the new highs, it just hasn't looked back. And so there's been a lot of talk about how overvalued the market is by a lot of metrics. And the thing that I like to look at is I like to look at the RSI to get an idea of how overbought it was. It got it got extremely overbought, and it's kind of worked that off a little bit, right? Um, I like to use a 9 EMA. Market's basically, been climbing up the 9. There's a little bit of a sell down below it. And like I said, I can't exactly remember what happened here, but it just basically, popped below it for a couple days and then regained it. And so with the 9 EMA, what I look for is if most of the price action is occurring over the 9, then, obviously the trend's up and the 9 is sloping up. And so, it's been a while since we had a period of time where, the majority, and I'm talking majority by like, a few days, a week or whatever, where you get like a run below the 9. And so, and that's the 9 EMA is a super fast moving average too. Anyway, all you can really say here is, for one thing, there's the 200-day moving average. Market's pretty extended from the 200-day compared to what it's been past couple of years. 200-day only goes back to there, but so, the market's a little bit stretched to the upside, but I think that, that part of this is that the shorts are just have been steadily sort of throwing in the towel, right? That could be part of it. The other part is that obviously, and I'm sure you've heard this, the standard sort of the standard narrative is that, the Fed liquidity is finding its way into the stock market. If there was like a major sell off, see, here's what's really crazy. If there was like a major sell off, the level of support like back here is significant. I mean, that's a huge level of support. It would feel like a bear market if the market retraced back to where it broke out here. So that's something to consider. I should do the calculation just for the heck of it. But anyway, that's the big level. The trend is obviously up and it's relentless. But here's the thing: is that going into now starting to talk about individual stocks. I read a statistic or I saw a chart or something that said like the like Apple and Microsoft and Google and Amazon, I think, or whatever, like 20% of the market cap of the S&P now, which is pretty extraordinary. Yeah, Apple just on a huge tear here, right? Every every investment dollar that goes into an index, the first place it goes is Apple, right? Largest market cap, most widely owned stock in the world or whatever. And so, as money comes in, it goes in first. The first dollar goes into Apple, and then of course Microsoft, and all these stocks are on the same kind of, just straight up tear here. So They say the market can stay irrational longer than you can stay solvent, and I guess that was made. Yeah, they came up with that a long time ago. I guess based on people trying to short what they perceived as an overbought or overvalued market, right? So there you go. Anyway, what I was about to get into here was the idea that our system, right? Let me go to. I want to take a look at the got the open trades here. I want to go through these as usual and take a look at them. But what I want to point out to begin with is that our system looks for stocks that have had a pullback, right? And sometimes it finds stocks that have just like sort of a shallow pullback and then resume their uptrend, kind of like P&G here, right? P&G is kind of it's a big cap, excuse me, large market cap stock, and geez, what I would say is, is a primary uptrend, right? And interestingly enough, I mean, you can see that way back here. I guess it was in January of, or yeah, it was late January of last year. We had a trade in P&G, and it was kind of the price action that preceded the entry here was kind of weird, but this sort of makes sense to me. All right, it's the system itself. You've probably noticed that there have been very few pending trades, and one of the reasons for that is that there's very few stocks that have actually had, that are in strong uptrends, that are in persistent strong uptrends, that have had reasonable pullbacks, right? Because the market hasn't pulled back. And so it's just the nature of the cycle. But here's the thing is the market moves in cycles and it shifts over time and nothing lasts forever, right? So it seems like the current run that we're on here is as far as the overall market is one that kind of day after day after day it goes on until everybody's convinced that it'll go on forever, and then something will come along and change that, right? And I have no idea what it is, but trust me, it'll eventually come along, right? The market doesn't go up in a straight line forever. So it's just sort of the nature of it. Anyway, so yeah, P&G looking pretty good here. This P&G is a very what I want to say sort of a low ATR stock, couple of percent. I had somebody ask me about the ATRs of about like looking at the because I mentioned sometimes about how the scaling of the chart shows you that it's a low ATR stock or whatever, but you look at the bars and it looks volatile, and so you know the best place the best place to find the ATR of a particular stock is, and there's not going to be anything over here, but on the triggered today list, right? That's going to be the average range in percentage. So when a new when one of these pending trades triggers that night after we do the update, it's going to show up here, and then when a stock shows up on the triggered today list, that means it's a buy the next day, as long as it's trading over the trigger price. Or if you get up in the morning, right, and check this before the market opens, then these are the stocks that are triggering in today. Of course, there's none today, but and so you'll see the average range right there. So there's been days when there's been three stocks that trigger in, and maybe a couple of them are trading at a 2% range or whatever, and then maybe there's one that has a much larger range. So anyway, If you go down to the pending trades, you can see the same thing, right? So we have three pending trades here: Wendy's, Campbell Soup, and this ARWR. And so there you go, right? That's the average range, which is basically, and as I've explained before, we use a monthly ATR. And so that's really all that's important. When you're looking at the chart or whatever, basically you should already have a kind of a good idea. So here's the idea is that, this ARWR, moves almost 5% on a daily basis, and so it's going to be more of a high octane stock, and so you would theoretically expect it. If it triggers in and you buy it, then you're going to expect a lot of volatility, a lot of percent moves, and so I mean that's just the thing to keep in mind. And so something like a P&G, or the other one that was on here, the let's just take Campbell Soup. Campbell Soup, this is a slow moving stock. The average range over, a month is 2%. Roughly 2%. It's rounded off. And so, you don't expect a stock that trades in a 2% average range to like go up 10%, in a week. That's just basically what the ATR is used for. So, anyway, so let's go back to the open trades here. Oh, and by the way, if you wanted to like really dig into that, and so see, I'm not sure what the significance. I did have a question about it, and I'm not sure that there's a whole lot of significance to it, but you can always put an ATR on your chart, right? And you can do the math or whatever, right? So right now the standard ATR is like 14 days, which is kind of weird, but if you figure there's 10 days in 2 trading weeks, and there's 15 trading days in 3 weeks. So, but anyway, the standard 14 ATR is going to show 58 cents, and you just divide that by the price here, and so that's how you would get like the percentage of the ATR, right? You actually have to do the math. So, and if you change this to like say a 30-day ATR, you get something a little closer to what our ATR is, because we're using the monthly. So anyway, not a whole lot of significance. I mean, the main thing to keep in mind is that when you see them on the pending list or the triggered today list, that can just sort of be a little guide of what to expect from the stock, when it triggers in, how volatile it's going to be, and what kind of percentages you're going to be looking at. So anyhow, back to these open trades. Let me go through these real quick here, just see where we are. P&G looking pretty good, right? I mean, if you zoom in on the chart, it's just kind of marching higher here. I expect this stop will start coming up here fairly quickly. It's still actually right here at the initial stop, which is below the low of this little pattern. So, and also keep in mind that we have earnings season coming up, and so that earnings season is this one's on 123, right? So still, there's still plenty of time for this to hit a new high, or to keep going up ahead of earnings out here in the future. That's 21. So, and that's 24. It's not that easy. You have to like really zoom in to be able to, or I have to like really zoom in. Well, let's see, 21 and 24. So anyway, earnings on 123 before the market open. Well, that's a weekend, so that's obviously going to get revised. But anyhow, still plenty of time on that one. One of the thing about earnings season is that there will be stocks that, and I've seen this before, stocks that are pending, that the earnings is what actually triggers them in, right? They have like a good pop on earnings or whatever. So, but anyway, earnings season is a little bit tricky because we close any open trades the day before earnings come out, and we try not to. If a stock were to trigger in, like, 2 days before earnings, then we ditch it, right? So let's move on here. Um, as I go down this list, as is typical, and this is just more of a fluke than anything, but when you just come over here and sort this, the older ones are going to be at the bottom, and then the stocks that have triggered in most recently are at the top. So, because it's sorted by date automatically. So, this one's kind of interesting. This PLD, because when we were looking at it last week, right, it had just basically just been zigzagging right around the entry point, right around the trigger price, I should say, and not really doing a whole lot, right? So this was last Wednesday here. It triggered in back over here, but last Wednesday it had just been meandering around there, and then all of a sudden, right? You see that occasionally. All of a sudden, one day out of the blue, you get that big long range day up, hits the target, and so I mean that's basically kind of what you want to see there. Oh, I'm sorry, I was looking at the wrong one. I jumped ahead of myself. I should have. There's PNG, and then the next one's Pod. I think I just glanced over at my screen and got the tickers confused. Yeah, this Pod. This is a pretty good example of what I had talked about the secondary target. Well, check that out. Secondary target got hit today. So basically, what you got here is, and this is the kind of pullback that you typically want to see, right? There's a couple pullbacks on this chart, but these are the kind of pullbacks that you want to see in the market, right? I guess. I mean, unless you bought up here at the high, and then you don't want to see a pullback like that. But this is the kind of pullback that the market needs, or an individual stock needs, in order to set up properly, right? A nice sort of relatively orderly medium duration pullback is what I should say, right? Not just like a little dip, kind of like P&G had just that little dip, turned right back up. Well, that's okay. That works sometimes, but this is kind of like what I would call a quality pullback, and then you get a turn, and so we look to jump in on that turn. But anyway, so here's a good example of one that where the trigger price was 174 and it closed significantly above the trigger that day. And so the next morning, what I have circled here is this is like, that would have been the decision point where one would have said, okay, the trigger was at 174, but this thing's opening at 177.50. Should I buy it? And obviously that's up to you whether you'd want to go ahead and just jump in. But the way that the system works is it assumes that, um, I know it's always been one of those sort of things because we call it a trigger price that people feel as though they want to get into the exact trigger, but um, we could if we called this like the breakout zone, and so a stock if a stock closes above the breakout zone, then it's just a buy. And so you don't necessarily want to sweat the small stuff because a lot of times I've seen in the past, and over the past year, I've seen every sort of situation come up, like every sort of thing happen where you could have bought it at the trigger, or it opened right at the trigger, it gapped way up, and I've seen everything happen. And I'm going to be honest and say that no matter how you do it, if you don't really sweat the small stuff, it's all going to sort of even out. And so, anyway, this is a good example for anyone new here that of where you'd go ahead and just say you could buy the full position, or the other option is you buy a half a position, set a limit order at the trigger. In this case, you would have not been filled on that. In a lot of other cases, some other cases, I should say, you will get filled on the second half on the trigger, And I know I spoke to an individual a while back that his little personal strategy was that he waits for the stock to hit the triggered today list, and then the next day he sets a limit order at the trigger to get filled at the trigger price. Well, here's one that would have never gotten filled. So anyway, my personal thought on the whole thing, and I've gone over this a few times, but it's always good to review this kind of stuff, right? So we have new people come in, and so here's my idea: is if you pay the extra $3.50 because that was the open the next day somewhere in that neighborhood. It's going to be an approximation, but just simply add that to whatever the target is to compensate for it, right? It's that simple. And so you're getting the same move from the calculated trigger price to the calculated target, where the idea is that you're going to sell half of it and let the rest ride. Or you can choose, you can always choose to, if you wanted to, you could sell it all at the target, but there's going to be some cases where you shortchange yourself significantly by doing that, right? And so, we looked at this CZZ last week, right? So, you know, there was the trigger back here, and then a couple days later it hits a target, and then it goes and it runs 30%. So you don't really want to. The idea then is that the target's the is kind of like the first target where you peel some off, and then like in this case, the stop is up here at 175 now, and so it's actually above the trigger price, and it's pretty darn close to where you would have triggered in if you bought the open the following day. So, so far so good. Now, of course, today, today does sort of look like one of those crazy reversal days on this, right? And so the funny thing is that you see these type of things like today, and you think, oh, geez, that's a pivot high reversal bar, whatever, but by the end of the day, this thing could go green, and then tomorrow, keep going up. And so I've seen that too. So in the morning, you never want to assume that, I mean, we've only got an hour of trading here, so you never want to assume that that's what it's going to look like at the end of the day. Anyway, we move on here. DHI, Home Builder, DR Horton. Yeah, nice little pullback. Kind of had some weird price action here, but so far so good. So there's the trigger, and this was one that gapped up a little bit the next morning, came down, and so far so good. There's the secondary target for if you got in up here, and so far so good. I mean, bigger scheme of things, that's a nice little sort of dip and a U-turn. And so stock like this has a habit of doing that. It sells off a little bit and then just rebounds, right? So far looking pretty good. This double check that I got the stop in the right place. Yeah, 52.70, sort of just below the price action of the past few days. This might have been one that I was talking about. I was talking about the ATR, the volatility being low, because you can tell the increments over here on the chart, and see these increments like the way that I'm zoomed in now. So there's 25 cents between the scales here, but if I zoom out on it, the chart, then there's 50 cents between the increments. And so I mean, that's just the automatic scaling of the chart, right? But typically, through my experience, I can look at the scale of a chart, whether I'm zoomed in or zoomed out, and see that, with 50 cents between these increments, it's a relatively low ATR stock. Even the and here's the thing. So this is getting into address the question that I had about the ATR and that. So I mean, yeah, if you zoom into the price action, it's always going to look more volatile, right? Like this looks really volatile. Then if you zoom out, it doesn't look all that volatile on a sort of a day-to-day basis. I mean, you see some big long-range days, but then you see lots of like little sort of narrow-range days too. So don't let that throw you off. I mean, it's in the big scheme of things, it's sort of just the nature of the charts. And of course, you can always look at the ATR and do a calculation if you're curious about what the average range is. But the thing of it is that the system's calculating all that, right? I mean, the target's typically gonna be just under 3 ATRs as far as the first target, and the stops are calculated based on the ATR in relation to what the recent price action is. So the system does a really good job of calculating where the trailing stop should sort of hang back, and the idea is that you want to sort of allow for normal price want to allow for normal price fluctuation without getting knocked out, right? While having the stop still as close as possible if the thing just fails, right? If it just fails. Now there's going to be cases, we've seen this plenty of times, where you get a stock that's in like back over here. Stock's in a really nice uptrend marching higher, and then you get like a sell off like this that knocks you out, hits the stop, and yet you come back down the road and the stock's higher. But you know that's just sort of the nature of the business, because once this trend line cracked, and say you were in over here somewhere and you got knocked out here, it could have just as easily failed. There will come a day where stocks sell off a little bit, and they don't just rebound and come right back, and then they go into what we call a deep pullback. So anyway, moving on. Moving on, GLDD. This is an interesting example of one that's basically gone nowhere, right? Like there's the entry, 1155, or I'm sorry, the entry, the trigger, 1155. This day closed over the trigger. Following day it opened like literally right at the trigger. So the open was 1150. The open was literally right at the exact trigger price, and that would have been this day right here. So that's the day right there. These little arrows. I mean, the weird thing about these little arrows is that they never actually. They don't stay. You can't put them on like the line. You can't put them like right on the day line like you'd like to. They always show up. But anyway, so there's the day it triggered in. Opened right exactly at the trigger prices, which is almost a quirk because that seldom happens, like at the exact trigger price. Anyway, it's gone nowhere. But interestingly enough, the trailing stop has just trailed up, trailed up, trailed up, and it's hovering like right below the low of this consolidation. Quite frankly, that's a pretty decent looking little pattern there, right? And so even though the stock is just consolidating sideways, the range is kind of narrowing. So if it gets something going to the upside, it could just take off, right? And so, but this is a great example of why you don't want to necessarily concern yourself so much about the initial stop, because that initial stop's typically going to be below, especially on something like this, going to be below a recent low or the low of the pullback pattern, and then it's going to trail up fairly quick. And if the stock goes nowhere, it's still going to trail up. It's still going to trail up, and Just an unusual situation, right? Like if this thing had pulled back deeper or whatever, then the stop probably wouldn't be all the way up here right now, but it is what it is. And so, one of two things is going to happen. I mean, you're talking between the trigger here and the stop, you're talking 15 cents, right? And so, if this thing doesn't take off, if it decides to pull back, then it's just basically going to be a scratch because the idea is that the old let your winners run, cut your losers short type of thing. If the stock's not going to make the move to the upside, then we don't want to be in it. And so that's just how it is. But this is a really interesting sort of situation because you don't see this a whole lot. Now there is one that we'll get to here in a second that had something similar, right? Like it spent a week or two just consolidating sideways and then just went on a big run. And so let's go to the next one was the PLD. That kind of chopped around sideways and then ran up all at once. We already looked at that. STAG. Here's another one that's just sort of it's just sort of chopping around in the context of a nice uptrend. And so you can see all the times that stops moved up, and and it's probably gonna within the next couple days probably gonna come up a little bit more to be under these lows. And so this is a pretty good example of how the stop sort of creeps up, but it still allows enough wiggle room that as long as the stock keeps going, this looks like the target that I have marked up here. So let me mark that up here. Let's see, yeah, 32 and a quarter is the target. So let's put that on here real quick. I'll be honest with you, the overall stock market really, really needs a sell off. It really needs a little shaking of the tree, right? It's overbought, um, and so we've seen that before. Some of you guys have been around for years, and we've seen these type of environments before, and they just sort of they lull everyone into a sense of complacency, and everybody, and you start to get a lot of complaining about, the market's just crazy overvalued and it won't go down in that. And so, things take time to they sort of morph like market environments. They morph over time. And so this is the one I was talking about right here. This DXCM. This is, by the way, this is the last open trade too. So, yeah, this one triggered in, right there's the close over the trigger. Following day opened right around. It's a very expensive stock, and then it just went sideways for a couple of weeks. Just went sideways for a couple of weeks, right? And and then lo and behold, couple of days, it busts out of that range to the upside, and you can see what happened. It plowed right through the target and sort of came back. You had this crazy volatile day, and interestingly enough, like the current stop on this 223.50 is it's just a shade. It's just a shade under that little low right there, was is sort of makes sense right now where it belongs. And then depending on what it does, it'll stay there for now. And depending on what this stock does, if it can make some forward progress and take out these highs, then that stock's gonna come up here somewhere. So right now, though, it seems like a pretty reasonable spot for it. And of course, it's already hit the target, right? And so that's 14 points, right? I mean, it doesn't look like a whole lot on the chart, but $14 and a decent gain, right? So this thing's as of the close last night, right? So it's down just a quarter of a percent today. This thing's up 8.8%. So that's one thing that I know it's difficult to look at a $200 stock, and especially if you don't have a big account or whatever. But the thing about it is that if you, and I talked about this a little bit last week, if you look at everything in percentages, then it shouldn't matter, right? Like and especially with nowadays with no commissions, right? It's all about, I mean, it's all about dollars. It's all about dollars and percentage gains and percentage, losses or stop outs or whatever. And so, if you went into every single stock with an even dollar amount, it shouldn't matter if the stock's, a $15 stock or a $200 stock, because you'd be going in with, X amount of money, and the percentages, percentage gains or percentage losses or stop outs or whatever, whatever you end up with the position is going to be based on the dollar amount that you went in with. And so, this thing being up, almost 9% here, um, is just as good as if you were in a $15 stock that went up 9%, right? As a matter of fact, this particular one has been open the longest, this DXCM here. This has been open the longest, and it's also the largest percentage gainer of the open trades right now. So, kind of interesting. And again, it goes back to the old let your winners cut your losers short, let your winners run. Right? So, like if the one we looked at where the stock's kind of gone nowhere and the trailing stop just keeps going up. If it doesn't get anything going, then it's going to be one of those, like, just like cut it at break even type of thing. And so, I'm sure you guys have noticed this, that the stocks that tend to get the big long runs tend to stay in the longest, because systems designed to stick with it as long as it keeps going up. With the caveat that the way that the trailing stops are designed is that they're going to tighten up, tighten up, tighten up in an attempt to, first of all, get to break even when it's feasible based on the price action, and secondly, to tighten up so that you don't give it all back. See, and that's one of the conundrums with trading is, and we've all done this, right? You buy a stock, it takes off, it starts moving in your favor, and you got a pretty good gain in there, and so you don't take any action. You just sit on your hands or whatever, and then at some point, you get a sell off or whatever, and then, you know, if you just sit on your hands long enough, there's a decent chance that it goes all the way back to where you bought it. You didn't lock in any gains, and so that's why conceptually the idea here is that we have these targets, a calculated target. The idea is that you take some profits at the target. You could sell it all. A lot of the targets are pretty high probability. We got a really good hit rate on the targets. I think I did like last October. I took the whole month or something, and I think I posted this somewhere, like a blog post or something. Anyways, yeah, I would say 80% of the stocks actually hit the target. And so, if all you did was sell at the target, you're going to take some short-term gains. If you sold all of it at the target, you'd take a lot of quick gains, and then just be patient, wait for the next one. But you will you'll miss out on the ones that really make the big moves, right? And so there's lots of little you know sort of ways you can play it, right? Like on this one, you could have taken some profits at the target, and then when it breaks above the target, if you wanted to, you could put your stop loss back at the target, right? And so that way, if it blasts through the target and never looks back, you're in. But if it can't do that and it just ends up testing the target again, well then you got out of the target. So the cool thing about the way the system's designed is that it's flexible, and you can do some fancy footwork yourself if you so choose. So Anyway, systems designed to pick the stocks, calculate the triggers and targets and all that stuff, and trail the stop up, and then you can sort of use that as like a little system and kind of have your own little strategy within that system. So, okay, so real quick, like I said, the market is in dire need of some sort of a down cycle or a sell off, and that's why there's only three pending trades in here, right? I mean, there's not a whole lot of stocks that have the type of correct or sell off correction that the system looks for because the market's been going straight up. However, Wendy's hit the pending trades a couple of days ago, right? And so I did, past couple of weeks I've done some pretty good analysis of how the pending trades work. And so, you know, when they hit the pending trades list, the idea is that ideally they're going to trigger out in the future and, typically at a lower price than when, well, yeah, generally speaking, I mean, it's going to be a lower price than when they hit the thing. Look at this. We've had a couple of trades in Wendy's that did well, like in the fall. One in October and one in November. So Wendy's has been a pretty decent stock for the system. This little sort of sell off here is not real convincing, and so I mean I wouldn't just jump into this thing here. The idea is that that's a sell off right there. That's the kind of sell off that would be ideal, and so that's why the trigger price is up here because we want to see something like that. We want to see it sell down over here and then have that trigger slowly come down and meet the price, out here. So anyway, let's look at Campbell's Soup. Campbell's Soup, pretty good looking stock, to tell you the truth. Another one that's sort of had a little sell off here recently, and you know, there's the trigger, and so it may continue to come down. It may bounce around, and then if it turns the corner here, if and when it turns the corner out in the future, then it could trigger in. Both Wendy's and Campbell's Soup show an average range of 2% here, so they're fairly boring stocks, right? I mean, but big brand name stocks, you don't have to worry about, you don't have to worry about too. The only thing you got to worry about is earnings, right? So I haven't looked up to see when the earnings on these are, but typically these kind of stocks, it's all about the earnings, right? That's when they tend to make the big moves, but and so like I said, earnings season is going to throw a little bit of a monkey wrench into what we're doing here. But so this is the last thing I'm going to talk about here, and I'm going to wrap it up. And this is the one that I talked extensively about this last week, right? Last Wednesday, the price was this day right here. Last Wednesday was that day, and it looked quite a bit different then than it does now. And so I explained how, and that was the trigger price last Wednesday, and I explained how it could come up and sort of meet this trend line out in the future, and you know sort of the however the this pullback sort of manifested. The idea is that the price would find a level, stabilize, and then come out in the future. So anyway, long story short, and this is kind of cool actually. So last week at this time, the trigger price was up here around 64. Well, the trigger price right now is at 60, right? So there, and so that's sort of a whole different a whole different ball game because, and one of the things about this is that it's a little tricky. It's a little tricky because that sort of bigger pattern or whatever, that's going to act as overhead resistance. But same sort of thing. If this stock can kind of, and here's the thing: if I put this on a candlestick, it's going to look a little bit different. Let me do that real quick. If I go to a candlestick chart, so anyway, it's more of an example of how. There we go. You put this on the sort of put this across the. That's gonna be some resistance there at 60, but ideally it would sort of meet it out here in the future, right? That's kind of and so this is a pretty volatile stock here, and so anything can happen. But ideally, at this point, the price would sort of drift sideways and then break this trend line, hit it out in the future. So, but the thing about it is that it could this is a pretty good sell off, and so if this low right here holds and this thing starts rallying back up, look at what happened back here. Very similar sort of pattern. Just a big sort of sell down, and then it reversed course, and you get that huge move there. So anyway, is what it is. Worth keeping an eye on, and of course, this entry price, the trigger price, I should say, can float with it changes and floats. And so if this thing were to sell down to if it were to sell down and close that gap, it would probably come off the list. It would probably just disappear. So if it doesn't trigger in and it sells off to a certain degree, it will not trigger in, and it'll actually come off the pending list. So there you go. So anyways, that's pretty much it. The market itself, the market itself needs a down cycle. Not just a couple days sell down, and not a huge long range day down or some sort of you know. It needs the actual and that's kind of the cool thing about individual stocks. Individual stocks will sell down for whatever reason. Stocks, sectors come and go from favor and that type of thing. And so, this run up's pretty extraordinary, right? I'm gonna say one more thing about the overall market. It's always levels that you want to keep in mind. These lows right here, what's that low? 32.12. That low's 32.14. So that's a big support level there. Um, this was sort of an anomaly, but if the market sold down and broke this level, then there's support levels all along the way here. There's support level right there at that high and that high, but the crazy thing is that the major support level, right? Like the next sort of the bigger scheme major support level is way down here. And so this sort of run up and this extension here is a little should make you a little bit nervous, right? It really should. And it seems like we're at the point now where, everyone's convinced that the Fed's got your back and the Fed money, coming into the system and all that. And so I don't know what to think. I've seen these types of you know what this reminds me of and I can't even go back there on the daily chart. I had to go to the weekly chart, but it reminds me of this on the weekly chart. Reminds me of January 2018, right? It reminds me of the fall to January of 2018, right? And we had the same sort of thing. Let's see, this is January. So this is a weekly chart, right? And so these one, two, these 4 weeks here were kind of, the market had been going up, going up, going up, and then kind of, looked like maybe it was ready for a pause or whatever. And then you got these 4 weeks that were kind of like a melt up, right? If you recall. And on the daily chart, they look kind of similar to where we are now, just sort of straight up at like an angle. And then all of a sudden, boy, 2 weeks later, there was a big sort of shock. And as I recall, there was nothing really, interest rates rose a little bit. Interest rates started going up. And that was basically what caused that kind of sell off. And it just kind of comes out of the blue, something weird like that. Some economic numbers or something come out of the blue, and then it's kind of like a wake up call. So the angle that this has been moving up for all these weeks is very sort of reminiscent of back then. So and I mean, and that doesn't mean that it can't keep pushing or whatever, but just be aware that you just can't, you can't assume that this is going to go on forever, which seems like it's kind of like the conventional wisdom. I don't know. I mean, no one really knows what to make of this because earnings are basically flat, right? Earnings drive the market. Earnings are basically flat to down. And so, I mean, it's not like, it's not like the S&P earnings are going gangbusters. And so there's a lot of multiple expansion and different weird things going on. So, anyways, all that aside, market obviously is doing great, and we just had to see what happens from there. So, thanks for tuning in. I will be back next Wednesday, and we'll discuss all this and see what the open trades look like next week. And I will see you then.